For many foreign investors operating in Vietnam, company incorporation is only the beginning. After the business becomes operational, one of the most important compliance obligations for foreign invested companies is the annual audit requirement. However, many FDI business owners in Vietnam underestimate how important audit preparation actually is. They assume the audit is simply a routine accounting exercise. But in reality, the annual audit often becomes the moment when hidden compliance weaknesses inside the company are exposed. Incomplete accounting records, missing supporting documents, tax inconsistencies, payroll discrepancies, or transactions that cannot be properly explained. These problems may remain invisible during day-to-day operations, but they frequently surface during the annual audit process in Vietnam. And once they do, the consequences can extend far beyond accounting itself. Under Vietnam regulations, many foreign invested companies are required to conduct annual financial statement audits. This is not only a procedural requirement. The audited financial statements may later affect tax compliance, investor reporting, banking relationships, profit repatriation, licensing procedures, and future investment activities. For foreign investors, the audit also becomes an important credibility test. Because audited financial statements demonstrate whether the company's accounting structure is reliable, transparent, and capable of withstanding external review. And in Vietnam, regulatory authorities, investors, and financial institutions increasingly expect stronger compliance standards from FDI companies. One of the most common mistakes foreign-owned companies make in Vietnam is waiting until the audit begins before reviewing their records. By that stage, many operational issues have already accumulated. Invoices may be incomplete, banking records may not align with accounting entries, tax declarations may contain inconsistencies, or supporting documents may no longer be available. This creates enormous pressure during the audit process. Because auditors cannot simply rely on assumptions, they require documentary evidence. And if documentation cannot properly support the company's accounting treatment, the audit may become significantly more complicated. In some situations, the company may need to revise accounting records, explain discrepancies, or address potential compliance concerns that should have been resolved much earlier. Many foreign investors believe auditors only review financial numbers. But in practice, annual audits for FDI companies in Vietnam involve much broader compliance review. Auditors may examine revenue recognition, expense documentation, payroll records, tax declarations, bank transactions, intercompany transactions, loan arrangements, contractual documentation, and the consistency between operational activities and accounting treatment. If significant inconsistencies appear, the issue may later attract attention from tax authorities or regulators as well. This is why audit preparation should not be treated as a last-minute administrative task. It should be part of the company's ongoing compliance strategy throughout the year. Many foreign startups and SME investors entering Vietnam attempt to minimize operational costs during the early stages of business, and accounting services are often selected primarily based on price. Unfortunately, this decision frequently creates serious audit difficulties later. Some low-cost accounting providers focus mainly on monthly filing submissions, without maintaining strong documentation control or compliance oversight. Communication may be weak, supporting records may be incomplete, and accounting treatment may not properly reflect the company's actual operations. As long as no audit occurs, the problems remain hidden, but during annual audit season in Vietnam, these weaknesses become highly visible. At that point, the company may face delays, additional professional fees, accounting revisions, or regulatory concerns that could have been avoided with stronger accounting management earlier. Imagine a foreign-owned service company operating in Vietnam for several years. The business used a small accounting provider because transaction volume initially seemed manageable. Monthly reports were submitted regularly. Management assumed compliance was under control. but during the annual audit process, auditors discovered multiple issues. Certain expenses lacked valid supporting documentation, several intercompany payments were insufficiently documented, payroll records did not fully align with labor declarations, and accounting classifications for some transactions were inconsistent. As a result, the audit process became delayed and significantly more expensive. Management then had to reconstruct historical records while responding to auditor questions under time pressure. This situation is more common than many foreign investors realize in Vietnam's FDI environment. For foreign invested companies in Vietnam, proper audit preparation begins long before the auditor arrives. Businesses should ensure accounting records are consistently maintained throughout the year. Supporting documents should be organized properly. Contracts, invoices, payroll records, and banking documents should align clearly with accounting entries. Management should also understand how major transactions are being treated from both accounting and tax perspectives. Most importantly, foreign investors should work with accounting providers capable of communicating transparently and proactively identifying compliance risks before the audit begins. Because once the audit process starts, correcting structural weaknesses becomes far more difficult. Many foreign investors view audits as purely financial exercises, but in Vietnam, audit findings can sometimes create broader legal and regulatory implications. This is why experienced FDI companies increasingly coordinate accounting, audit, and legal oversight together. At LTS Law, we regularly help foreign investors assess operational compliance risks connected to accounting and audit preparation. Although LTS Law does not directly provide accounting or audit services, we help clients identify professionally assessed accounting and audit partners experienced in supporting foreign-owned companies in Vietnam. Our goal is not simply helping businesses complete annual audits, it is helping investors reduce long-term compliance exposure. For many foreign investors in Vietnam, the annual audit is the first real test of whether the company's compliance structure is truly sustainable. And unfortunately, many businesses only discover weaknesses when the audit process is already underway. At LTS Law, we help foreign investors understand that strong compliance is not built during audit season. It is built through proper accounting oversight, documentation management, and legal coordination from the beginning. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on annual audit preparation, accounting compliance, or selecting suitable accounting and audit partners, book a consultation with LTS Law. Because in Vietnam, a successful audit depends on much more than numbers alone.